Good morning, good afternoon, and good evening. Welcome to the third Elgar webinar on central banking and monetary policy. This is part of the first book of a series of 10 books on the topic that I am co-editing with Silvio Capes from Brazil and Guillaume Vallet from France. This first book is called The Future of Central Banking, and today's session contains two speakers, two contributors to the book, and we welcome them and we welcome everyone to this webinar. I do remind you to please mute your microphone when you're not speaking, and we will have each talk, and then there'll be some comments from the audience. Today's webinar is co-hosted by Silvio Capes, one of the co-editors from Brazil. And I turn the webinar to him now. Thank you.
Well, thank you for coming. It's nice to see many friendly faces here. Professor Fernando Ferrari Filho, nice to see you here. And today we will have two presentations, one from Simone Deos and another by Esteban Perez Cladentey. I will briefly present them and then pass the presentation to them. Professor Simone Deos, she is professor at Unicamp, Brazil. Her main areas of research are financial fragility and instability, bank regulation, financial integration, and public banks and development. And Esteban Perez Caldente is currently chief of the Financing for Development Unit within the Economic Development Division at the Economic Commission for Latin America and Caribbean, or CEPAL in Portuguese or Spanish. He does research in development economics, macroeconomics, and monetary economics, and history of economic thought. We will start today with Simone, and then we will open to some questions, maybe 4, maybe 5 questions from the public, and then pass to Esteban and another round of questions. I will now pass to Professor Simone, and I will share my screen because I have her slides here, and I will pass the slides for her. So give me just 1 second to share the screen. Okay, can you see? Can you see the slides?
Yes.
Okay, so Professor Simone, it's with you.
Okay, good morning, good afternoon, or good evening to everyone here. It's a pleasure to be here with you. First of all, I'd like to thank Rochon for inviting me for this webinar and for inviting me as well to participate in this book of the future of central banking. And today I will present some ideas on macroprudential policies and financial stability that we have been developing. Silvio, please, if you can. Okay, so we have been developing, I have been developing with some co-authors, and they are Olivia Bulho and Laís Araújo Silva, that we are developing together a chapter for the book, The Future of Central Banking. So the main question of the chapter and the main questions of my presentation today are related to how recent technological and financial innovations like crypto assets and decentralized payment systems threaten macroprudential policies and financial stability. Okay. So going back a little bit, we depart from the fact that after the 2008 crisis, the task of improving banking regulation gained importance. We all remember what happened in 2008. In spite of being now in the middle of a terrible crisis, I think that for most of us, what happened in 2008 and after 2008 is still present in our minds, in our memories. So we remember also that after that terrible crisis that was generated inside the financial system, the central banks have the task of improving banking regulation. So in general, we can say that central banks kept the main idea of the old regulation. We can call this old generation Basel regulation. And the main pillar of Basel regulation is that banks have to have capital requirements related to the risk-weighted assets that they have. So this basic pillar was kept, but some other aspects were added to the Basel model regulation, like banks had to add cyclical capital requirements in order to smooth the business cycle or the credit cycle. Banks also had to have liquidity requirements, which were not required before the crisis, and so on. And also more and better capital became necessary. So things that were accepted as capital before 2008 crisis changed a little bit. So central banks became more restrictive in which assets they would accept as capital, and in general, more capital were required from the banks as well. So all these came to be known as macroprudential regulation, and this macroprudential regulation would be necessary in order, as I said before, to smooth the business cycle and prevent new crises like the one we had in 2008. Silvio, please. Thank you. So, but the point here is that financial innovations, many financial innovations, as usual, developed after the crisis. So one can consider as a side effect of the last crisis the increasing importance of crypto assets. One important story here that we don't know how much of this is true or is real. There's a lot of, I could say, it's not exactly gossip, but something like that around this figure called, this person called Satoshi Nakamoto. So in 2008, someone that maybe is called Satoshi Nakamoto, but we don't know for sure if this person exists or if it's a group of people, or we don't know. But let's say he announced that that he was creating what would be a new currency, an encrypted, decentralized, peer-to-peer digital currency called Bitcoin. Bitcoin was not the first cryptocurrency. We can say a currency that was created with this new technology of encrypted technology. But it was for sure the first one to gain importance because it has solved old problems like frauds and etc. Silvio, please. Thanks. So one important question, and I think that nowadays we don't have doubt about that, but one question would be if cryptocurrencies would replace state currencies. According to Nakamoto, Bitcoin would that would be an advantage, an allegedly advantage to Bitcoin relatively to other currencies. Also, another reason for Nakamoto and the people that supported his idea would be that this peer-to-peer encrypted technology would be able to turn Bitcoin into the base of a more efficient payment system. But, so here we can see some charts, and the idea here is to present to you some data that can show how Bitcoin is not more stable at all related to other currencies. So the idea that this currency, decentralized currency, with the supply not being controlled by central banks, would be more stable than other currencies, at least until now, is not true, according to the data. And okay. So we can see from one side that bitcoins or cryptocurrencies that are not issued by central banks are not replacing central bank currencies. But on the other side, okay, so a little bit before, because why they are not replacing central bank currencies? Because money is a unit of account, and the state has the power to declare what is money and to issue what Keynes called the money proper. And banks also have the right to create money if they are allowed to central banks to do so. And both these monies, central bank monies and bank monies, are at different levels in the money pyramid, okay? So here we have what we can call a money hierarchy, and we have this image of pyramid of different kinds of monies. In many places, we can call Minsky here. He is an author that liked this idea of money hierarchy, but this image we brought from Olivia Bullo's PhD thesis. So we have at the top of this hierarchy state money, and we have at the second level of this hierarchy bank monies, and we have in what we can call a third level of this hierarchy near monies and other financial assets. So this idea that we have a hierarchy of monies is important to our argument as well. Thank you. So on the other hand, if crypto assets are not replacing state money, they are in fact pushing central banks to develop their own cryptocurrencies, as well as to develop decentralized instant payment systems. And so this new technology is allowing also non-banks that we can call in general fintechs to participate in the payment business, what is a novelty basically. And they have been pushing to offer more services to their clients in their accounts. So they are pushing to not only participate in the payment system, but also they are pushing to increasingly become more similar to what banks do. Progressively, and we have been seeing that now, apps that were initially focused on text and voice messages, and here in Brazil we are very used to a message, to one of these apps, that is WhatsApp app. So they are pushing also to allow their clients to transfer money through it, but initially using their bank accounts. But people say, and I think this is a very strong hypothesis, that the goal would be for these apps to launch their own digital accounts as well. So I think one important question here for us to discuss is, which are the impacts for regulation and financial stability of these innovations in the financial landscape, let's say. So first of all, we don't know yet if Basel III, a macroprudential regulatory framework, I mean the regulatory framework that came after the 2008 crisis, works well. We have now an opportunity to see if it works well, because we are in the middle of this terrible corona crisis. And we can say that corona crisis is exogenous in the sense that it's not, of course, generated. It was not generated in the middle of the, economic system or banking system, but we know that it poses important threats to the system. And we are observing now that central banks are acting in order to smooth the effects of the corona crisis all over the economies. Also, financial activity is changing very rapidly with new technologies. I mean, with the fintechs, with the new payment systems that have been developed by central banks. And we could say, apparently, that the boundaries of the financial systems are moving as well. So I think we have some questions to think about, and questions that are related to the impacts of these new technologies and new boundaries to the financial regulation and financial stability. One question is, how central banks are going to regulate the new participants of the payment system? How they are going to regulate and how they should regulate the new participants of the payment system in order to ensure financial stability. And second point, what else besides participating in the new instant payment system that allegedly will bring more efficiency to the system and will reduce costs and reduce prices for the customers. But what else will the fintechs, generally speaking, will be allowed to do? Are they are going to be allowed to perform like banks? And one last point for us to think about and discuss would be in which sense the operation of this new system can affect the monetary policies procedures. I mean, the procedures that central banks do at the reserve markets, and which are going to be the impacts of this new financial system in the monetary policies effects in the economy, and if we have and if we can expect that the money hierarchy or money pyramid, as the one I have showed before, will change somehow as a byproduct, let's say, of these new financial products and these financial innovations that we have been seeing lately. So I think that's it for us for now. Thank you, Silvio, for helping me. Thank you.
Thank you, Simone, for your presentation. We will now open to questions from the public. You can also unmute yourselves or raise the hand. There is an option to raise hands here at the software. So Mario already raised his hand. Okay, please, Mario.
Okay, thank you. Thank you, Simone, for a very interesting presentation. I very much appreciate it. In fact, I wrote something on that. I presented at a session that Louis-philippe organized at ASA last, January in San Diego. And digital currency. And what you highlighted about the fact that there's an emerging banking side to that is important. But at the time, when I mentioned that, I said, it's true that they can offer, they could advance credit. You hold deposits. It's like any other bank could do, in that sense. However, unlike any bank, so to speak, they're not part of a payment system is integrated with central banks, so to speak, okay? And therefore, the whole thing could just collapse very quickly unless they are large enough as banks. So I was thinking, and that's at the time, I was looking at this, what they were proposing with Facebook Libra. And Libra, if it's big and wide enough, so to speak, then it can, in fact, you know, advance credit and expect in the reflex that it gets it back, so to speak. Okay? Because otherwise, if you're just a tiny, you know, if you're just one among many digital currency banks or whatever you want to call it, crypto banks, it will not, they will not have that ability. So the point that I was trying to make, and in fact, that's what I'm commenting, but also the question here, which is that the system cannot really, you know, the banks in and of themselves cannot really do two things. One, either is a big bank, so to speak, very large, that can run on its almost, and Libra is a possibility, but they were blocking it. I don't know what's happened ever since, not with this coronavirus stuff. I don't know what is possibility, which is that they will somehow join together and create an old separate, you know, system in place that would be able to cover all that, which is, again, it's possible, but it's not, you know, necessarily likely, okay, that they could do it. So that's the question that I pose. Is it feasible at that level?
Is it, sorry, Mario.
The system could actually generate, become a real competitor to the banking sector at large. I know for sure that in fact, we published a paper by that at that conference that Louis-philippe had organized in 2019 in France, you know, where Guillaume had also been organizing. There was a paper from what's his name there? Oh my God! And it was a good paper that I published in the journal on exactly that issue of central bank digital currencies that Beinzel had written on. That is very important because clearly central banks could just destroy any of these private currencies if they want. But it has not happened. And then the question is, if they let it be as is, what can the, you know, crypto banks in a sense really function without central banks, which is the fundamental issue at the end, you know, which is of course something that I think is highly questionable unless they're so large. Okay? It's like a big bank in the world called crypto bank, you know.
Mm-hmm. Thank you. I'm not sure if we're going to, if I am supposed to answer Mario Secareccia immediately,
yes.
or we're going to
you can answer now.
Okay. So thank you, Mario, for your very interesting points. I'm not sure if I got it right because the sound was not perfect, and but let me see if I got it right. If I didn't, please let me know. So I think that your question is about if the crypto banks can work like banks. I think, and you mentioned that we have to think that, as usual, in the beginning of this story comes the idea that if we have many, let's say, crypto banks competing, we are going to have a more efficient system. Will be, and this system will be more able to operate to their clients with charging, you know, less fees and charging, you know, more affordable prices for the services. But one interesting point is that as we see in capitalism, we know that, and we have been seeing that also in Brazil, is that, you know, big institutions are buying, you know, small fintechs, and they are kind of incorporating, you know, this new technology and turning them into bigger, you know, enterprises. So if this happens from one side, we won't be able, you know, to see the good results of this new technology in terms of, you know, loans with small, you know, small interest rates for the customers, and also less fees charged on the services that which we paid for banks in order to do our transactions, because they are going to be a part of an oligopoly as well. So this is one important, I think, question, important point to think about. Another point is that I agree with you when you say that if they remain small enough, so there is no problem, you know, they don't challenge the financial stability. But if they are allowed to grow, and if central banks allow these mergers and acquisitions operation, and if central banks allow these crypto banks to become big banks, so they can threaten the financial stability, unless central banks regulate them as if they were banks, because they will be turning into banks. So this is my position. Not sure if I addressed your points, Mario.
Yes, you did. Thank you very much. But my point also was that if it's large, the bigger, so think of it, there's one big crypto bank,
yes,
world, then in a sense, it creates its, you know, as I said, it's a creator of money with, you know, that is outside of the whole, and it does not need outside influx of liquidity, unless within that chain, within that, there's questions about it, which have to do with perhaps, it's more like household liquidity preference, things like that, that created problems in securities, for instance, in the case of you know, ordinary banks, you know, commercial banks. But otherwise, it's an evolving thing right now, which is that it can become something that can challenge, so to speak, you know, the commercial banking, but only, as I said, if these central banks allow it to happen. Because the irony of this is that as you started with the presentation, that digital currency, the way it appeared, it was promising the holder that this would be a highly elastic supply, so to speak. Well, in reality, what's happening as these banks, as these crypto banks are starting to emerge, is the complete opposite.
Yes.
In time, which, as I said, is a kind of, you know, it's contradictory here, obviously, and it's real issues, which, as I said, even the Congress in the US was trying to deal with in the case of Libra, because that's the thing. It's a big organization. It could have its tentacles all over the world through Facebook. And then what happens, you know, in that kind of world?
Yes, yes.
But yes, yeah, we don't disagree. I was just posing the question at that level.
Yes. No, very interesting point you made about this kind of contradiction that we can see, because Bitcoin announced that it would have an inelastic supply. And now we see that if, you know, this whole thing succeeds, so we'll have a very elastic supply of cryptocurrencies. It's very interesting. Other than that, they cannot be currency.
No, I agree.
Yes, Yes, very, very, very interesting. Thank
Okay,
you.
so let's move to the next questions. I already have lots of raised hands. I'm afraid we will not have the time for everyone. Simone, do you mind if we collect the questions and then you answer them in a block?
No, not at all. Yes, you can do that.
Okay, so I will end the query of the questions with those 5. So first will be Domenica Tropeano, then Paul Tulloch, then Nahib Khan, David Leadbetter, and Vincent Grossman-Reith. So those 5 questions. So Domenica, please, if you can ask your question. You're muted. Let me unmute you. Okay,
Well,
now we can hear you.
Yes, you can hear me. I came late, but I found interesting the speech, and I'm arguing there's a lot of debate, even among heterodox economists, on whether the central bank should create their own cryptocurrencies, so replace in a way these private cryptocurrencies or this private enterprise who could offer a cryptocurrency. But the point, which, for example, there is a recent paper on the Levy Institute economics website by Savona and Kriegel on this topic, and they argue that the central bank should intervene and replace, in a way, private cryptocurrencies with their own supply of cryptocurrency, digital, the central bank money, and so on. But often the problem is that if the central bank offer to private entities an account at them, so with a digital currency, so commercial banks would stop making their normal business, that is that of having of lending and having on the liability sides deposits. So there would be a sort of full reserve banking in a way. So banks would only act as investors in the market. They would finance themselves on the capital market and then lend and so on, while the central bank would offer would manage the payment system and offer all the money. Central bank money would replace deposits in a way. That's I am asking whether the authors or the author of this paper considered that point, the point I'm raising.
Okay, thank you, Domenica. Now, please, Paul, if you can ask your question.
I was wondering on the one chart that compares the variability between crypto and regular currencies. One, is that a fair assessment? Because these are two different beasts, right? Crypto doesn't have all these institutions and such behind it, so we should expect a difference. And two, what is causing all this variability that's preventing cryptocurrency from, I guess it's answering my own question in a sense, but has there been some research done on what are creating these massive swings in crypto variances and valuations? Obviously related to the fact that they are not like a central bank and have institutional supports and regulatory processes. But I think it's a key aspect of not allowing that.
Could you please pose the second question again, if you don't mind?
Yeah, I'm just wondering, like, what is creating the variances in the cryptocurrency valuations? Like, we see these wild swings of Bitcoin and Litecoin and all these other cryptocurrencies. Like, they're massive. Has there been a lot of research done inside of like what's creating these large swings in the value?
Okay, thank you.
Okay, so now the question from Nahib, who in the chat said he sends greetings from Saudi Arabia. So greetings from Brazil to you, Nahib.
Well, thank you very much for taking my question. My question is about, and thank you for the presentation. My question is about the major argument in favor of cryptocurrency, particularly Bitcoin, that it has a limited supply, which will further stabilize the monetary system. So my question is that, first of all, I read somewhere that it's about 21 million at the maximum level. So what stops us from further dividing into tiny, mini Bitcoins? So let's suppose I have 1 Bitcoin, I could just simply divide it into another 1 million or 100 million or 1,000 million tiny nano Bitcoins. So there's no limit in that case for supply. And my second argument would be that back, I don't know how many years when this limited supply was created, and because we know that these cryptocurrencies are a product of computing powers, every day we are having a better and enhanced computing powers almost daily basis. So how could we say that, well, tomorrow's computing powers won't be able to generate more cryptocurrencies or Bitcoins? Thank you.
Thank you, Nahib. Now, David, please, your question. David Leadbitter.
Can you hear me?
Yeah, we can.
First of all, thank you for your presentation. I found it stimulating. I want to go to the issue. For me, a key part is not the fixed supply. I think it's actually being changed, and as different Bitcoins arise, that will affect the supply as well, and that would have to be regulated even by people who have a classic theory of money. So I wonder, for me, about the question of efficiency, and I really feel that has to be discussed. The issue of information is not adequately assessed. This is a complex commodity. It's not simply a medium of exchange. It's also a medium that has potential enormous information. And it's been handled, and I support this, with concerns about privacy. Like, I firmly believe that there won't be a purely private Bitcoin, that for reasons of international crime, for regulation, for money, etc., and that many of the major data mining firms are interested in it, like Libra, I think has that potential too. So for me, there's a complexity here about the information associated with the exchange and how two conjoined products are entering the market here in a way that doesn't exist with simple currency. And I think, I'd like you to address the efficiency. For me, this is a potential field for data mining and for capitalist exploitation. And it's one reason that I think the analysis has to be much sharper on the nature of what this efficiency is and what exactly is the product. Okay, but thank you very much for your presentation.
Mm-hmm. Thank you, David. Now the last question by Vincent.
Hi, everybody, and thank you also from my side for the presentation. So I'm not an expert at all on cryptocurrencies, but at Banque de France, I tend to see some of the discussions going on. And so I was wondering, at the first question on the distinction between crypto assets and cryptocurrency. On the graph you showed on the volatility of the price of Bitcoin, I was wondering if it wouldn't be good also to show some example of what they call stable coins, which are also kind of assets, but which tend to replicate currencies more than the Bitcoin, which is not supposed to do that. And it's really an asset in itself. Then the second remark would be on the difference between what we call retail CBDC when we are talking about central bank digital currency, and wholesale CBDC, because that's also very different animals. So I'm not sure how do you you would include this distinction in your remarks. And just to finish, again, it's not my topic of research or business on a day-to-day business, but still today was launched a new initiative for the innovation hub of the BIS, and so all central banks are working quite a lot on these topics, and that's clear that all these aspects are going to be looked deeply in these circles. And I think maybe more on the regulation side, beyond macroprudential policy than macroprudential policy by itself. But anyway, that's an important topic. So yeah, thank you.
Okay, thank you. Now, Simone.
Okay. Thank you for all these questions and interesting observations. Not sure if I will be able to address them properly, but I'll do my best. Okay, so first, Domenica, I think you pointed out a very important aspect, that is that these new participants of the digital payment system can affect the very business of banking, because they can do something that turns bank into pig banks, not, as we know, commercial banks that can create money, but as pig banks, because they are not going to be able to participate in the reserve market. So if I got your question, I'm not sure if it was a question or if it is your point appropriately, I think you have a very, very good one. And at the final bullets of my presentation, I've mentioned that we should think about the challenges that this new technology and this new banking model or this new financial landscape brings to monetary policy. But I think that before thinking about that, we have to understand, as you pointed out, how is that they are going to challenge the very banking business, because being at the core of the payment system is crucial for the banks do banking as they do, create money. So thank you for your point. I am sure that we are going to think deeply on that in order to address this point. Maybe not for this paper, maybe for this chapter, but at least later on. Thank you again. So the second observation, second questions. Yes, I think it's not that fair, to show only some graphs, and I agree with you that we should, and we'll try to do that, give more accurate data on the variability of the currencies, and try to explore deeper why is that Bitcoin is has this volatility. But we have one hypothesis, that is that Bitcoin is not a currency. Bitcoin is an asset, and it is its behavior. It's a behavior of a kind of speculative asset. So maybe we can compare volatility of Bitcoins with indexes like Dow Jones index and things like that, to see if they go more, they correlate more. So we could advance an hypothesis of, you know, which assets they are more proximate, if they are more proximate with equities, if they are more proximate with maybe peripheral currencies that you know, have strong variations as well. But it's interesting. Thank you. Nahib, yeah, your first point that maybe there will be no limit to divide and multiply the supply. The supply of bit currencies. Yeah, thank you. I never thought it's going to be the first time that I will give this idea. I thought I never, you know, it never happened, never occurred to me to think on it. Yes, interesting. We are going to give a thought. And your second point is, can't we say that tomorrow we won't have more Bitcoins? I don't know. I would say that we will probably have more Bitcoins tomorrow. Yes, I think that's it for now. David, if I got it right, I think that you were suggesting a more sharp political economy analysis of this new currencies and new technology. Thank you. I think it's a very good point. And you developed that when you said that information is not a regular commodity, and there is a complexity that connects information with transactions. And at the end of the day, you know, the one that operates with that and the platform, the app, the system, wherever, will be able to have all the information that they need in order to do anything. So again, you said that efficiency is not, you know, what we have to look at and what we have to criticize, but information, you know, information, what means to have access to all this information in terms of political economy. Thank you. Very, very good question. So about the last question, again, not sure if I got it right or if I got it completely, but I think that one point is, which is the distinction about crypto assets and cryptocurrencies. So our point is that we don't have these Bitcoins and other, you know, so-called cryptocurrencies that we have until now. They are not cryptocurrencies, they are crypto assets. We won't have cryptocurrencies until central banks issue cryptocurrencies. So until now, we don't have cryptocurrencies. They can be called a cryptocurrency, but they are, from our point of view, crypto assets. So your second point would be that we should maybe to explore the difference of digital payment system for wholesale banking and for retail banking. Yes, we could that. We didn't do that until now, but it's an interesting point to develop. And I didn't. You mentioned at the end of your question about BIS launching a new. I'm not sure if it was a new report or a new project. I am not aware of that. I was not aware of that, but I will, and we will. My team, Olivia and Lais, that are working with me, we are going to take a look on it. So thank you very much again. Thank you.
Thank you, Simone, for the presentation and the answers, and thank you all also for the questions. Now we will move to the second presentation by Esteban. So please, Esteban, whenever you want.
Yes, thank you very much. I'll share my screen then.
Okay.
It says host disable participant screen sharing.
So I think if you can send it to email to me or to Louis-philippe Rochon, then I can pass the
okay.
Or if Louis-philippe can enable that.
I sent it to Louis-philippe, but I'll send it to you right now. Okay, hold on.
Okay. Let me see if I, as a co-host, can allow that. Okay, I allow it. Please try now.
Okay, hold on for a second. Yeah, now I can do it. Okay.
Okay.
All right.
So
let me see. Choose it. Okay. Hold on for a sec. Okay.
Okay.
Hold on, please. And if you can see right now. Let me see where I can. Just hold on for a second, because it's not showing the presentation. So let me.
No problem.
Okay, here it is. Okay, can you see it? Okay, great. So I'm going to be focusing on macroprudential policy and financial stability. And in particular, I'm going to be arguing that macroprudential policy responds really to the type of vision that one has about the workings of the financial system. That's number one. And then I am going to be also talking about the vision and the role of monetary policy and its functions regarding financial stability and macroprudential policy. First, I would like to fix some ideas and talk about the necessity for macroprudential policy. Why do we need macroprudential policy? Macroprudential policy, as the last speaker mentioned, was really emphasized after the global financial crisis, but macroprudential policy per se dates back at least to the 1970s. We know that the number of banking and currency crises has increased throughout the world. This is a chart taken by from an IMF paper from 2018 by Levin and Valencia, showing the number of banking and currency crises between 1970 and 2017, and obviously they have increased. We know that the more recent and most important crisis which did not have the epicenter in developing economies, affected a number of countries. That's the number one thing. The number of banking and currency crises has increased. The other stylized fact that's important and that justifies macroeconomic policy is the fact that since the middle of the 1990s, crises have exhibited more of a systemic character. This is something that's not only championed by or argued by heterodox economists, but also by mainstream economists. This is a graph from Guillermo Calvo, Currency in Times of Crisis, which shows how the tequila effect, the Russian crisis, the tequila crisis, affected all emerging market economies, let's say in the case of the tequila crisis, beyond only the case of Mexico. And that the global financial crisis, in a recent report by the IMF, the report shows that it affected 19 economies, representing 67% of world GDP, whereas the previous crisis, I think the 2002 bubble dot, the effects were felt with less intensity in terms of countries. The third stylized fact that justifies macro policy is the effect of financial crisis on the long run, its long-run effects on growth and investment. This graph shows the rate of growth of global GDP in the 5 years prior to the global financial crisis, during the crisis, and then 5 and 8 years following the crisis. And you see that the GDP pre-crisis levels were 3.2, post-crisis levels around 3.1 or 2.9, and investment definitely has also declined from 3.0 to 2.0% in terms of rate of growth. These are three stylized facts that justify the need for a macro prudential policy. Now, macroprudential policy and the way it's implemented, the way it's devised, it's structured, depends on the way we view the financial system. And I think there are basically three views of the financial system. The first view, which is championed basically by neoclassical economists, but goes back to Schumpeter in a certain way, that links finance to growth. And the idea of linking finance to growth is that finance contributes to growth by producing ex ante information, investment opportunity, ex post monitoring of investment and corporate governance, facilitating risk management, mobilizing and pooling savings, and easing the exchange of goods and services. The second view is the view espoused by most financial theories. This is a graph that shows the basic theorems of financial economics, the efficient market hypothesis, risk and return, the Modigliani-Miller theorem, and the Black-Scholes-Miller-Merton options theorem. And these are all the assumptions all of these different financial theories assume in terms of normal utility maximizing risk averse agencies. Investors have homogeneous expectations, stock prices follow a random walk, no danger of bankruptcy, etc. In this view, finance simply doesn't matter, it has no effect. A third view, which I'm going to be focusing, is that banks are driven in the financial system, but I take here the banks to exemplify this behavior, are driven like any other agent in capitalism by profits. And when we analyze banks, we should have a profit equation. This profit equation is taken from one of the articles by Minsky, where it can be shown that the rate of return over equity is equal to the rate of return over assets multiplied by leverage. And I think this is a very simple equation, but it's an equation that can help, for example, to classify bank strategies in terms of the way they see their workings or the way they maximize their profits. We know that in the up until the global financial crisis in the developed countries, the strategy was based not so much on rate of return over assets, but on leverage, so that the rate of return over equity increased with leverage, with debt. This was not certainly the type of business model that was followed in the South in developing economies. In developing economies, you had very little leverage. I'm talking, for example, about the case of Latin America. But where banks made their profits is through rate of return over assets. And obviously, rate of return over assets can be decomposed into net interest margins and taxes and provisions, etc. But if the type of banking model that we have responds to this idea of profits. I remember that in the 1990s, banks in Latin America were viewed as being inefficient because their net interest margin was much larger than that of developed economies banks. But in reality, what they were doing is increasing their profits by increasing the rate of return over assets, because they were limited in the way they could increase their profits through leverage. What are some of the third point that I wanted to make, or the third theme that I wanted to focus on, what are some of the manifestations of this quest for profits? What you find in general, for example, this is a graph that shows JP Morgan, Wells Fargo, Bank of America, Citigroup, and provisions for loan losses for selected banks in the United States. And what you find, first of all, is a cyclical behavior in terms of provision for loan losses. You can see clearly that for all the banks, the provision for loan losses increased with the global financial crisis and then tended to decrease. And this certainly contributes to the procyclicality of credit. The other manifestation, for example, is a procyclicality in leverage. This is leverage for Citigroup that I calculated on the basis of Bloomberg data from 2001 to 2015, and you see a clear increase in terms of leverage prior to the global financial crisis. As I said before, this belongs basically, this is a behavior basically adopted by banks and in the north, let's say in the center, in the developed countries, and in particular by global banks. You have also a positive correlation in terms of the rate of change in assets and rate of change in leverage, in the sense that the growth in balance sheets is financed with debt. This is a graph that shows quarterly data for the major banks in the United States, with a correlation coefficient of 0.89, something you had like that for the crisis. Another manifestation of this quest for profits prior to the crisis was the interconnectivity. And this is an exercise that I did with a research assistant, trying to show the connectivity for different types of banks in the United States, Asia, and Europe. And the larger banks are the ones that have more connectivity. Another empirical evidence of connectivity is correlation between the rate of change in assets of banks across the world. This shows for 2007, 2009, the correlation coefficient for rate of growth of assets for example, for Citibank, Credit Suisse, Deutsche Bank, Goldman Sachs, JP Morgan, Wells Fargo, and Japanese banks related to each other. And the yellow squares show the case where the correlation coefficient is positive and statistically significant, which are a number of banks throughout the world. They moved exactly in tandem. An additional, let's say, an additional point or a piece of evidence regarding the way banks behaved is how the financial system influenced the real economy through its involvement in the physical trading of commodities. And this is a paragraph taken from a report by the United Senate Permanent Subcommittee on Investigation in the report on Wall Street bank involvement with physical commodities. And you can read, for example, the first sentence: until recently, Morgan Stanley controlled 55 million barrels of oil storage, 100 oil tankers, 6,000 miles of pipeline, built a copper inventory that peaked at 2 billion and at one point included at least 213,000 metric tons of coppers, comprising nearly 60% of the available physical copper on the world copper trading exchange. And the same thing with Goldman Sachs, and the same thing with other type of banks. And not only were banks involved in using leverage to increase profits, they use also real assets such as commodities. And this is, for example, an analysis of breakdown for an R-square. It's an econometric model for the variation in commodity prices. And you can see, for example, this is from 2093 to 2007, and then 2008, 2018, how, for example, the index of economic activity has decreased. It's important in terms of the variation in commodity prices, where stock market, federal funds rate, and treasury bond yields have all basically increased. Now, the idea of trying to regulate the financial system following the crisis follows a model that actually does not correspond to the profit motive. It follows a model that sees basically that banks are sort of intermediaries between households and investors. This is a graph from Shin, where he tries to schematize the banking system before the global before the build up to the global financial crisis, and the transformation of the financial system, let's say a little bit prior to the global financial crisis, before the build-up crisis financial system was fairly straightforward. We went, for example, from deposits to investment. This is illustrated with mortgages, and in the period during the build-up to the global financial crisis, the global financial system became much more intertwined, with the household going to the money market fund, commercial banks, security firms, mortgage pool, and then went back to households. It made the banking system much more complex, because it extended or made the chain between savers and investors more complicated. And this led, let's say, to the way macroprudential policy was organized, to the way it was viewed, and to the way it was implemented. Macroprudential policy tries to regulate, and this is just the neoclassical story, tries to regulate the financial system as a whole, to try to maintain its stability by minimizing systemic risk. Systemic risk is a risk of disruption to financial services that is caused by an impairment of all parts of the financial system, and has the potential to impose serious negative consequences of the real economy. The initiatives to regulate the financial system after the global economy that had something to do with this notion of macroprudential policy were basically three. The first one was steps to increase capital requirements of financial institutions as embodied in Basel III, which also comprise, let's say, countercyclical buffers and other type of more macroprudential policy. But essentially the Basel regulation is founded upon increasing capital requirements. The second initiative was led by the Financial Stability Board, which included the design of a methodology to classify and monitor banks considered to have global systemic importance and which have the capacity to generate contagion in financial markets worldwide. And the third initiative, and the one that has the largest regulatory perimeter, was without doubt the Dodd-Frank Wall Street Reform and Consumer Protection Act in the United States. And one can try to classify or can try to organize macroprudential policy according, let's say, to a view of the banking system that follows an accounting procedure, where we have assets for the banking systems, liabilities, and the assets we have loans for final use, household funds, government. On the liabilities, we have debt, banking institutions, and then we have equity being equal to assets minus a liability. Out of this, we can try to come up with this type of equation, which is a type of equation developed by some people at the Banking of International Settlement, where the loans for final use and the credit dynamics are a function of the leverage of the financial system, the transactions from outside the financial system, and capital requirements. So that all these three, let's say, regulatory initiatives actually can be summarized, and one can try to extract their different sort of regulatory measures in terms of whether they are trying to regulate the loans for financial credit dynamics, let's say with caps on loans, the leverage, the transactions from outside the financial system through measures to decrease interconnectivity, leverage by imposing leverage requirements, and capital by increasing capital requirements or other type of assets and capital in the liability side to try to improve the balance sheets of the financial system. Now, what has happened since these frameworks were implemented or are in the process of being implemented? We know, for one thing, that the value of global financial assets has continued to rise after the global financial crisis. This is a graph showing the evolution of the value of global financial assets and world GDP. From 1980 to 2009, you will note a big increase between 1980 to 2007, but after that, assets have continued to increase. What we have seen basically is a bigger concentration in the banking system in blue, which shows the concentration of those banks, the percentage of assets that the banks with assets above 250 billion US have. That the whole graph shows for 1984, 2018. And the asset share of deposit financial insured institutions, this is taken from the FDIC data of the United States, exceeded $250 billion, represented 10% in 2000. Right now, they represent about 50% of the total assets of the banks that have their deposits federally insured. Some of the manifestations or other things that we have seen is that the rate of return of equity, generally for all banks, have decreased. This shows the rate of return of equity for the banks that have more than 1 trillion in terms of assets. That's the big four banks. I think they're above Citibank, JP Morgan, Goldman Sachs, and New York Bank, I think. Then banks between 100 billion and 1 trillion in assets, then banks between 25 billion and 100 billion and less than 25 billion. And you can see the big drop in terms of rate of return on equity as a result of the control of leverage. So macroprudential policy, by controlling leverage, instead of controlling really the stability of the financial system, it may be controlling part of the stability, but it's also affecting profits of the bank. And so the banks go somewhere else to make their profit because that's what drives their activity. So at the same time that you try to regulate the financial stability of the banks, you're actually inducing maybe financial instability in some other part of the financial system. And indeed, what has happened since the global financial crisis due to this graph, to the declining profits that obviously had to do with the crash, with with the effect of the crisis on banks' activity, but also due to the regulation, is the rise of the bond market. This is a graph that shows the amount outstanding of international debt security and cross-border loans at the global level. Bonds as a percentage of total liquidity have increased. They represent more than 50% or 53% of all cross-border transactions. And these bonds, not only they go to developed economies, they also go to developing economies. And this is very important because what macroprudential policy and the view behind macroprudential policy has done is to transfer sort of the risk, to transfer sort of the origins of instability from the bank sector to the non-banking sector. And what's curious when one analyzes the bond market is that behind the bond market and behind the growth of the bond market is the growth of non-banking industry, whether it's the insurance, pension funds, but also all the asset management funds, the asset management industry that has been really one of the main beneficiaries of the global financial crisis and of the macroprudential regulation. And when one thinks about the asset management industry, and one looks at the asset management industry, one finds that it's extremely concentrated. BlackRock, for example, has in terms of assets about $6 trillion. You compare that with one of the global banks that have about perhaps one something, but less than $2 trillion in assets, then you can see that also that the non-banks are tied to the banking industry, because the Deutsche Bank, for example, not only has financial activities in terms of a global bank, but also acts like an asset manager. You can also, if you expand further regarding the non-bank sector, you will see, for example, that BlackRock owns about 30% of the stock on average of the most important French companies. BlackRock has become recently the manager or the agent of the Federal Reserve to purchase titles from the non-financial sector, non-financial corporate sector, and asset managers have a big stake in terms of bonds, in terms of debt. A big part of the emerging market economy debt today is in the hands of the non-bank sector. And that's one of the biggest, I think, threats to financial stability caused by the type of macroprudential regulation that is behind that is sustained, let's say, by a certain view of the way the financial system works. Another interesting feature that's occurring that has to do with this is that not only non-banking sector include pension funds and insurance companies and wealth funds, they also include the non-financial corporate sector. The non-financial corporate sector has become much more financialized following the global financial crisis, and it acts to a certain extent as a financial intermediary. So that financial intermediaries are not only banks or not only non-banks that do some type of financial activity, it also includes the type of activity that's traditionally carried by the real sector, by corporate firms. This is some calculations that we did with a couple of colleagues at ECLAC that shows short-term flows as a percentage of total flows, and where we classify short-term flows as including not only portfolio flows, but also intercompany loans that are generally classified as FDI, but in fact, which behave as short-term portfolio flows. And you will see that if you add all that together, the short-term flows really represent about 50% of what or the type of flows that goes to Latin America, and around that much that goes to the rest of emerging market economies. So this not only focuses on developed economies, but also spills into domestic economy. The second point, and this I'm going to finish, I wanted to focus on the first point, which was a vision of the banking sector. And another feature that I'm writing on the chapter is the role of monetary policy and the functions that monetary policy has in terms of macroprudential policy and in terms of financial stability. And I'm not going to go over it because we're almost, I'm running out of time, but I just wanted to show you this graph that shows the evolution of long-term average interest rates. This was done by a set of developed countries, OECD countries, from the first quarter 2018 to the third quarter of 2019. The long-term nominal interest rates, how they increase, and at the same time, how global debt has increased. And this idea that I'm trying to develop in the chapter is what is the role of monetary policy? Does monetary policy have to follow some kind of Tinbergen principle where they basically one instrument, one goal, or is monetary policy should be oriented towards other type of other type of instruments? Because what we see is that the policies are that have reduced the rate of interest in generally have been accompanied by an increase in debt. Debt at the global level stands today at 320% of GDP. Debt is increasing at a faster rate than global GDP, and obviously the world cannot borrow from Mars or Jupiter. The decline in rates of interest in Europe has pushed certain yields, government yields, into negative territory in the non-bank sector, for example, in pension funds, insurance, which in turns leads these institutions to search for higher yield, which means riskier assets. As the chain goes through the financial system in general, what you find is a decline in the yields, a decline in the yields for short term, with independence of the maturity of the instrument and with the independence of the risk. So the idea of distinguishing risk by maturity, or the idea of distinguishing risk by type of rate of interest, is really something that's, from my point of view, not disappearing, but it's sort of homogenizing, so you can distinguish both. So it makes a very blurred picture of the type of assets an investor is buying, whether it's a very risky asset or whether it isn't, because they will have similar yields for those assets. That's what I wanted to share with you. Thank you very much.
Thank you, Esteban, for your excellent presentation. We will now open to questions. Is that okay with you, Esteban, if you collect questions like Simone?
Yes, it's better because, yeah.
Okay. So I'll wait until the hands are raised.
I have a
People
question.
can also, sorry, Louis-philippe, but people can also write the question at the chat if they want. So Louis-philippe, you have a
yeah, and if I can answer all the questions or anything like that, if you have questions, there's an email on the presentation, you can send it to me.
Thank you. I apologize. It's always something with Zoom. Now, this week, for some reason, my video is not working. But I do have a question. In your last slide, and for me, this is what motivated my interest in macroprudential policies. You said that the lower interest rates have encouraged, I think that's the word that you use, massive borrowing. My question is why? We tend to blame this massive borrowing on these low interest rates, whereas where I come from, this borrowing is the result of the lack of macroprudential policies to begin with. So I don't necessarily see, you know, a direct relationship between interest rates and borrowing. But, you know, if there were proper policies, macroprudential policies in place, you know, you would not see this, I think. You know, because I always hear a lot of neoclassical people blaming these bubbles, blaming these crises on low interest rates. Anyway, that's my question.
Okay. Okay, thank you.
Okay, so people haven't raised hands yet. Esteban, so if you want to answer this question while people...
Yeah. Well, the way I see it is basically the decline in rates of interest, and also the quantitative easing policies have made it easier to increase your debt. I don't think that's a neoclassical argument, and I think at the same time there has not been, for example, there has the non-financial corporate sector has increased its debt tremendously, and that's because it's much cheaper to borrow than, for example, to finance with sources. For example, when you have differential rates of interest, it's easier, for example, to use your funds, for example, to do carry trade or to speculate in the financial markets. But I think that certainly has helped to increase borrowing and to make the system more fragile. If you think, for example, the fact that government yields in Europe, in several countries, have negative rate of interest, and if you think that, for example, pension funds or insurance companies have a certain regulation where they have to have certain amount of government yields in their as assets, well, if you have a negative yield, you're going to have a problem unless eventually you can go to other assets that have a higher yield. I would assume. And which are the assets that have a higher yield? The riskier assets that have a higher yield. And I think that certainly can be a source of financial fragility. The question is, does the Fed decrease interest rates because they want to maintain financial stability? Or does the Fed decrease interest rates because they want to increase inflation, and they want to increase inflation in order to boost demand? Which is it? And that, I think, it's very important. I think the quantitative policies were not policies that were meant for financial stability. They were policies that were meant to increase aggregate demand. And if you read, for example, the portfolio channel of Federal Reserve policy, which is the preferred policy of let's say, in the mind of Bernanke when he talks about quantitative easing policy, is is a transmission mechanism, whether it's the Friedmanite transmission mechanism, whether you increase the price of an asset, interest rates decline, then you go to the next asset, a price increases, interest rates decline, and so on until you have a structure of the rates of interest that are lower, and the structure of the rates of interest pushes up demand, and that pushes up inflation. And that's the mechanism. That's very different from a mechanism meant to maintain financial stability. The fact, for example, I'm sorry, hello? Ooh, I got it. Hello? Yeah. The fact, for example, that that the decline in rates of interest decreased yields and decreased the profitability of some assets led certain investors to invest, for example, in commodities. And the commodity boom that affected other countries, which was followed also with an exchange rate appreciation, was the effect of the monetary policies of the Fed. And today you have exactly the same issue. When the COVID hit emerging market economies initially, you had a giant outflows of capital from developing economies to developed countries. And the outflow in March, was the biggest one recorded since the 2009. And now capital flows are coming back, because supposedly investors are looking for higher risk and higher yields. Why is that? Because of the type of policies that the Federal Reserve implements. Think about the fact that the dollar, think about this fact. I don't know of any other country that had a financial crisis whose currency was strengthened. During the 2009 crisis, not only people were demanding dollars, but the dollar has increased its role as a reserve currency ever since. So whatever the Federal Reserve does in terms of interest rates to maintain, let's say, aggregate demand, and that's what it's doing now, it's aimed. It has an effect or spillover into the rest of the world. And it's not necessarily a spillover effect to maintain stability. So I think there are conflicting goals in terms of your central bank policy and your financial stability policy. And I think if you look at the statements of the chairmen of the Federal Reserve and other banking, their main role is monetary policy, not really financial stability. Financial stability is basically, in their view, guaranteeing the financial stability of the payment system, but not the financial stability in terms of macroprudential policy.
Okay, thank you, Esteban, for the answer. We have 3 questions now, so let's collect them.
Okay.
The first is from Domenica Tropeano, and then Nahib, and then Simone. So Domenica, please.
Okay.
No, okay, now you can listen to me.
Yeah, we can hear you.
I would like to make an observation on the issue of leverage, because according to some scholars, I think the same you're quoting in the graph with the pre-crisis simplified financial system, and then after the crisis, more interconnected and more complex financial system. The measure of leverage is underestimated, because after the crisis, the big banks, they developed a technique of increasing leverage, which is not possible to account or to measure through the common measure of leverage. So they use a lot of collateral, and they increase leverage through the rehypothecation of this collateral. And there are some type rehypothecation. I don't go into details because it's all explained in this paper by seeing leverage a broader view. So in this way, actually, the leverage which is recorded and which is measured in the studies that you quoted by the major financial institution and so on is underestimated. And also some other measure, macroprudential measure like liquidity coverage ratio, for example, which in the US are binding because every bank must follow this ratio every day. It is not so in Europe. In Europe, banks, they have to implement this liquidity ratio, but only after some months, they calculate the sort of average. So this is a way in which macroprudential policies has not worked and many other things like this. So I think the amount of leverage and the amount and also the measure to which some big banks have continued to behave in the same way as before the crisis can be underestimated. I don't know what you think about that.
Thank you, Domenica, for the question. Now, Nahib.
Okay, thank you very much again for taking my question, and thank you so much, Esteban, for a very good presentation. You raised some concerns about non-banking sector having a very, very large portion of assets under their management compared to the banking sector. Now, my understanding is that if they are non-banking sector, well, first of all, they have these real assets. So as a monetary economist, I don't know, I won't be worried about them. Second question is that if they are non-banking sector, they won't have that much, capabilities or what we call potential to have leverage, like create money. So why these concerns? If maybe if my understanding is wrong, please correct me. Thank you.
Thank you, Nahib. Now, Simone, then David, and I will close with those last two questions because we already a lot of time here. So, Simone, please.
Thank you, Silvio, for taking my question, and thank you, Esteban, for your very, very interesting presentation. I have one question, and my question goes with Rochon's first question, and it's about that that kind of conundrum that we have when monetary policy is released, and we have an increased, let's say, financial fragility at that. So my point is that, and I would like to hear that from you, is that maybe we could go beyond monetary policy in itself. And my guess would be that in order to think about that, we should incorporate fiscal policy as well in our picture. Because if we have released monetary policy, but if we don't have a fiscal policy that is a pro-growth fiscal policy, the result seems to be only increased financial fragility and inflation of the assets and not growth with stability. So I would like if it's possible to comment on that. Thank you.
Okay, thank you. And then last question to it's David now. So please, David. David Leadbeater, are you there?
Can you hear me now?
Yeah, we can.
Okay, thank you. First of all, thank you very much for your very interesting paper. I want to focus on your theory of concentration. One of the things that you mentioned was BlackRock, and I've been also, wondering about it. And where are the economists in explaining the status of this enormous concentration of wealth? And I'm curious if you have a theory of how this corporate concentration is increasing and why, and how it's related to your general perspective on the financial sector. I mean, you mentioned the fact, for example, of I think 6 trillion of control, but also a massive amount of ownership in the French corporate sector. I think these are profound issues, but from an economics point of view, for someone like myself who's teaching in micro, for example, I think this phenomenon needs to be explained. Why the concentration has been so massive and so rapid relatively. So do you have a theory about it? Thanks.
Thank you all for the questions. Now, Esteban, that's up to you.
Yeah, the first one is the issue of leverage. Leverage can be measured in several ways, and certainly it can be underestimated, but the decline in leverage estimated through the measures I've seen and the measures I've computed is very high, it's very big. And maybe it's increasing, has increased somewhat, but the fact is that the profitability that comes with it in the global banks, from my point of view, has decreased. Now, obviously, the fact that global banks, for example, are interconnected with asset management industry, obviously, when you try to see them, both accounts are not separated, you can get a bigger leverage. But the idea that I'm trying to say behind this is the financial system is going to the non-bank sector. Before the crisis, it was much more in the banking sector. And that for me is an important issue and is an important stylized fact. And that non-bank sector, not only does it affect wealth management, it affects the more traditional pension funds like insurance and also the non-financial corporate sector. And that's a change from the global crisis that you didn't have before. And that I think merits a separate analysis. And that brings me to the issue of wealth managers. Why is wealth management, why am I worried? I think that when you have a company like BlackRock that has so much wealth, that owns stocks all over the world, that owns bonds with debt, that can impose certain to emerging market economies certain rules regarding that, it's a big problem. I don't think that BlackRock and the interest, the fact that BlackRock is the agent through which the Federal Reserve, the only agent through which the Federal Reserve buys non-corporate debt, that does not create conflicts of interest. If one takes a look at what is a wealth management management industry, the fact that they're so intertwined with the global banks before the crisis, the fact that they move very pro-cyclically and very short term because their rate of return depends on the investors directly into the wealth management. It's a different type of finance. It's a different type of managing liquidity and of managing money. That, from my point of view, is very short term, very pro-cyclical, and I'm still worried about the concentration and the too big to fail issue that was so prominent before the global financial crisis. It comes back to other agents. So my point of view is that if there was financial fragility before the crisis in the global banking system, that financial fragility is now in the non-bank system. And that requires an important change in terms of macroprudential policy. That's what I'm trying to say regarding that issue. Whether do I have a theory? No, I don't have a theory. I have some points. I wrote a paper that that was published in International Journal of Political Economy. Mario gave me a lot of comments on it. that talks about some possibilities regarding the growth and why there has been a tremendous growth in the asset management industry and why the asset management industry has been benefited from the quantitative easing policies that were undertaken in order to boost demand. But it would be, I have to leave soon, sorry, but that's what I can say in terms of a theory now. In terms of comprehensive micro theory, I don't have one yet.
Thank you, Esteban, for the answers and the presentation also. And before we finish, let me share my screen again with you, just to advertise the next presentations. Can you see it?
Yeah. All right. Before I leave, I just wanted to thank very much Louis-philippe for the invitation. Yeah, and thank you all for your patience and your questions.
Thank you, Esteban. So just to advertise, our next webinar will be next Monday, July 6th. Please pay attention that this is the only one with a different time. It will be 1 p.m. at New York time, and the next and final webinar of this series will be on July 13th. So please put that on your agenda. If you want this, I can send it to you by email or Louis-philippe Rochon too. And thank you all for coming here today. It was a pleasure to see you all. And I don't know if Louis-philippe Rochon wants to say something.
Bueno, Esteban habla 7, 8 idiomas, así que no me extraña.
Sí.
Okay, so thank you for showing up, and I hope to see you all in the next webinars next Monday and the other Monday. So bye-bye.